Thank you for joining me today on this edition of the Falcon's Nest. I'm your host, Connor Graham, Head of Financial Advisory Services at Graham Wealth Management. As you no doubt heard, Silicon Valley Bank, ticker symbol SVB, recently suffered a significant collapse, resulting in its shutdown by U.S. regulators. This marks the second largest bank failure in history and the largest since the 2008 financial crisis. Naturally, this news has caused concern among investors regarding their investments in bank stocks. In this discussion, I'd like to provide some insight into the reasons behind SVB's collapse and explain why analysts like Morningstar think major banks are currently considered to be okay. To understand what led to SVB's downfall, we must first look back to early 2020 when the COVID crisis triggered an unprecedented liquidity flood, which resulted in a boom in venture capital activity. SVB, which positioned itself as the bank for venture capital markets, saw a massive inflow of deposits, growing from $61.7 billion in 2019 to $173 billion by December 2022. With a compressed net interest margin spread, writing loans was not very attractive, so SVB decided to park the excess liquidity in U.S. Treasury securities and other similar low-yield risk-free notes. However, when quantitative tightening, QT, began and interest rates started to rise, bond prices fell, causing the value of these securities to depreciate sharply. As the value of its fixed income holdings dropped, concerns about a depreciating asset base were exacerbated by a deposit outflow, leading to an impending balance sheet crunch. When the market woke up to SVB's struggles, the meltdown happened quickly, serving as a reminder of how rapidly conditions can change in today's hyper-data-driven real-time markets. It's important to note that this collapse was caused by an idiosyncratic balance sheet composition that is not matched by major diversified banking giants such as JP Morgan, Bank of America, and Citigroup. These larger banks did not invest as heavily in overvalued U.S. Treasury securities, and JP Morgan, Bank of America, and Citigroup ended the year with significant net cash positions, respectively. While major banks are currently considered to be in good shape, a banking crisis could still spiral out of control quickly. Confidence is a crucial aspect of the banking business, and it is built on beliefs that may be shaky, sometimes influenced by moods rather than facts. The collapse of SVB was due to a unique balance sheet arrangement caused by being overweight in volatile investments affected by the Federal Reserve's aggressive war on inflation. Although larger banks might currently be considered to be okay, it's important to remain aware of the potential systemic risks of banking failures. As a financial advisor, I highly recommend conducting thorough research and analysis before making any investment decision and seeking the advice of a financial professional before making significant moves. By doing so, you can help protect your portfolio from unexpected market events and make informed investment decisions that align with your financial goals. Thank you for tuning into the Falcon's Nest for your financial information. Remember to like, subscribe, comment below, and click the bell icon to get notifications of future uploads. And as always, consult a financial professional before acting to determine what is best for you.